Hello, this is Mike Swanson. I run the website WallStreetWindow.com. The odds are that you're watching this video because you got an email from me about it. This is my first video about the markets for 2023. Uh, I'm doing it on Sunday, January the 8th, and I just wrote a pretty lengthy blog post that'll be coming up, posted on the website Monday. If you want to get that, make sure you're on my email list. The link to subscribe is on the bottom of this video. Now, what I discuss in the blog post, and it's got more charts that I'm going to show you, but it's essentially my outlook now for the markets for the next couple of weeks, months. There's some positive developments inside the stock market and new stock market leadership and sectors that can help the market going forward too. We're not going to return to the way the stock market was before 2022. The leaders of 2021 and 2020 and the funds that invested in them, such as the ARK ETF, aren't going to do that well. They're not doing well now, and there's no reason to think they're going to do any better. Are going to continue to lag the S&P 500. Bitcoin is going to continue to be awful. And so are things such as Coinbase, buying Tesla, buying the Meta. These type of stocks that were once hot are doing bad, but the market the past 2 months has been doing good. That's because there's no new leaders. There's new stocks leading the market. And that's the way to win in 2023 is to focus on these situations and ignore the fads of the past. Things change in the markets. So let's get into this. This is one of the most important things that I follow. What you're looking at here are the number of stocks inside the New York Stock Exchange above their 200-day moving averages. Now, in 2021, this indicator is at the top. It was in decline while the S&P 500 continued to go up. This was in 2021. And the Nasdaq 100 continued to go up too. But the number of stocks inside the stock market was above the 200-day moving averages was declining. This is the number of them. There's another indicator with the percentage of the stocks. It was below 50%, well below it by November of 2021. Now, what's important is I was drawing a lot of attention to this in the summer and fall of 2021. The indicator peaked out in June. And what it meant was that the internals of the stock market were in a sharp decline, even though the averages were still going up. This situation historically precedes either corrections in the stock market of 20% or more or new bear markets. It was flashing a red warning signal. Now, it didn't tell us in June, May, August, or June, July, August, September, when the market would roll over, but it said it would, and when it did, it would be a vicious decline at the least, and maybe something drawn out, which is what happened. That decline began in New Year's of last year when the averages turned down, Nasdaq falling over 30%. Now, the good news I have to tell you now is that this indicator of the number of stocks above the 200-day moving average turned up in October and in November, while the Nasdaq and the S&P continued to trade down. So it formed a positive divergence in October when it had a negative divergence the year before in the summer and the fall, telling us, watch out, watch out. Now it's saying, look, there's strength inside the stock market. In fact, there's more strength inside the stock market than is evident with the S&P 500 and the Nasdaq. this is an interesting situation. What it means is that there's more stocks going up than the 100 stocks in the Nasdaq 100, or the heavily weighted S&P 500 by market cap. The S&P 500 is heavily influenced by stocks such as Netflix, Google, Apple, Amazon, Tesla, because these stocks have the biggest market caps in the stock market. They heavily weight the market cap weighted S&P 500, and they dominate the Nasdaq. So these two averages, the Nasdaq even doing worse than S&P 500, are doing worse than the couple thousand stocks in the stock market. Stocks outside, in one way you could say you would be better off buying a stock out that's not inside the Nasdaq 100 than buying one that's in it, or buying the Nasdaq 100 itself. And that situation is likely to continue for the rest of this year, and honestly, probably even longer than that. Something similar happened after the year 2000. There is a stock market technology bubble that peaked out in the year 2000. There was a big bear market, but more importantly, those stocks such as Cisco, Oracle, Amazon back then, lots of them, internet stocks, to eBay, they were super stocks in the 90s, but after 2000, they lagged the S&P 500 for over a decade. Gold did better than the Nasdaq. Even the Dow did better than Nasdaq, although gold did better than the Dow. And we're seeing a similar shift now happening in the markets, which I think is not just a temporary thing, but is going to last for a very long time. But the very fact that this strength of the internals, and you can see it's doing better than the S&P 500 and the Nasdaq on the bottom of the chart. The Nasdaq is not that far from its October, November lows, while this indicator showing the internals is near highs seen since April. So strength inside the stock market. Avoid big cap tech fads. Avoid them. Look for the leaders. And I'm going to show you some of these sectors that are the new leaders. And that's what I think you need to focus on. One is mining stocks, gold mining stocks, and silver mining stocks. This is the GDX exchange traded fund. And look at the indicator on the bottom of this chart. It's GDX divided by the price of SPX, S&P 500. Creates a ratio. And when this ratio goes up, it means GDX is outperforming the S&P 500. The ratio closed out 2022 higher than it started 2022, but it has been going up since October. So it's leading this current stock market rally. It's not the only thing doing that. I own a position in GDX in my IRA. I own various stocks inside the CTF in my main investing account, and I'm going to continue to do so. But what about beyond the gold mining stocks? Well, let me show you another program that I use to look inside the stock market. And it's called TC2000. You can find it at the website warden.com. So one of the things that this software will do is break up the stock market into 142 sectors. And what I've done is you can see this is right here where it says industry indexes. I know this is hard to see on YouTube. That's why I don't always, go to it to do these YouTube videos and use those other charts that look so much easier to see. But this is critical information. And what I've done is taken these 142 industry groups, they call them industry indexes, and rank them by performance since September. And here's what we see. Farm products is at the top. This is a sector that's just got one stock in it, so it doesn't count. But here are the top performing sectors. Copper is at the top, up 46%. People tell you to buy crypto and Bitcoin to get 46% returns or other, these big returns, but copper is doing that, whereas crypto is still dead. Gold up 35% since Labor Day. Gold stocks, that's GDX. Silver stocks are next. Coal is next. Oil and gas equipment, industrial metals and minerals, which there are a lot of stocks in that sector, and they can pay some nice dividends. Examine that sector. I own stocks in that sector. I don't own any coal stocks, but I'm thinking about buying some now after looking at these things over the weekend. Apparel stores, insurance and reinsurance companies, farm and heavy construction machinery. Think about John Deere. Medical devices, broken out clearly. And interestingly enough, resorts and casinos coming alive. I'm not sure, what the big reason is for that. But one factor that I was asking myself this as I looked, and gambling revenue in the United States has grown by 10% in 2022. So maybe that's a reason for this. Residential construction coming alive. Steel companies, remember I mentioned steel companies, they're coming alive. Beverage stocks and brewers, something to consider. Look for them. I'm going to do it. Let's examine that together. I haven't looked at that one yet. Footwear and accessories coming alive. Drug manufacturers, insurance, more insurance, airport stocks, semiconductors. Now we've come down and we're getting into stocks that are kind of just matching the performance of the S&P 500. What are the worst sectors? The sectors to avoid. Auto manufacturers. My gosh, why would anyone continue to hold Tesla when not only is it the worst performing stock in the entire S&P 500, but the sector it's in is doing awful. It's the worst performing sector in the past couple months. You don't want to be in the laggards. You want to be in the leaders, the things outperforming the market, the things that can fuel the market higher. Consumer electronics at the bottom, utilities at the bottom, internet content at the bottom, down 14% while the market, is up over the past couple months. Don't be in losing situations. Don't be in stocks in this sector like Meta, Netflix, Amazon. These are not the places to be. REITs aren't doing well. Residential REITs not doing well. Health insurance stocks not doing well. REIT industrial is not doing well. REIT office is not doing well. Got a theme. REITs not doing well. Software applications not doing well. Infrastructure for software not doing well. Solar stocks not doing well. Special retail not doing well. Shipping and ports, auto trucks and auto dealers not doing well. Another REIT sector of hotels not doing well. Diversified REITs, real estate services. So you get the theme, real estate, REITs, get out. That's not the place to be. Big cap tech, not the place to be, because solar stocks, not the place to be. Remember that relative strength plot I showed you with GDX and how it was going up? Avoid things where that plot is going down. No, those aren't the situations to be in. I don't care if they're popular. I don't care if you got a Robinhood app and you load up and that's what everyone else owns. You don't want to be in laggards that everyone else owns. You want to be in the things that few people are in that are coming alive. That's what gold's doing. That's what material stocks are doing. That's what coal stocks are doing. Do you know anyone that owns a coal stock that's telling you to buy coal stocks? No one on TV is telling you to do that. No one on YouTube is telling you to do that, except, I guess, myself. But that's something to think about. Now, let's look at, just out of my curiosity, let's see, what were these leaders? Let's look at the casinos and this beverages in breweries. What's going on in these two sectors? Well, the magic thing about this software is not only do we see the sectors, but we can drill in to see what stocks are inside the sectors. So let's do that with these two sectors. And I'm going to scroll down to resorts and casinos. So let's check this out. Personally, I like to buy stocks that pay dividends. So we're going to look at the top paying dividend stocks first. Here's Red Rock Resorts. Here's Vail Resorts, paying a 3% dividend. Marriott Vacations, Boyd Gaming, Wynn, that's really breaking out, is one of the best performing stocks in this sector so far that we're seeing. Doesn't pay. Most of these casino stocks suspended their dividends in 2020. So that's why most aren't paying. Here's MGM. That one's coming alive. It was up 5% a few days ago. Las Vegas Sands is one of the best performing stocks here. I would note that Las Vegas Sands has casinos in China, Macau. That's probably the reopening in China is probably what's making them come alive. MLCO, what's this one? Melco Resorts, Golden Entertainment, Century Casinos. Here's one that's near a low if you want to bottom fish. Penn, I would avoid Penn because it got too popular the past couple of years. Caesars is lagging the others. But anyway, we get an idea of what here's one that's come alive. MSC leading the others. I'm not really that excited personally that piling into this sector, but I was just curious about it. And as I write in the blog post, if you look outside the United States, foreign markets are now doing better than the United States. And so I put some money in foreign markets and foreign market ETFs. And I think that's going to continue to be the story. I explain why in the blog post I'm putting up on Monday. You can find it there if it's not Sunday and it's Monday. Just go to Wall Street Window, you can find it. So we want to look at the brewery companies. I'm curious about the brewery companies too. Where are they? Beverages and brewers. What is going on in this sector? I like to look for the ones that pay the dividends. I think this is a foreign stock. I don't know. Ambev, Molson Coors, paying a 3% dividend. Here's one that's got a really nice looking chart. It's some sort of foreign stock, judging by the name of it. I'm just going to write it down. I'm going to look at it in more detail. Momento Economico, another stock, maybe a foreign one. I'm interested in foreign stocks because the US dollar index has turned down and I think is going to continue lower this year. That helps foreign stocks. That's why foreign markets are doing pretty good now, beating the S&P 500. Here's a Boston Beer Company, makes Sam Adams. That's good, a good chart. Budweiser right there, a really nice chart. If you want to, look, if you own Tesla, sell it, buy Bud. If you own Meta, sell it, buy Bud. I'll guarantee you'll know more people drinking Budweiser beers than you do using Meta goggles. It's simple as that. Sell Meta, buy Bud. Sell Meta, buy Bud. That's my, I'm not your investment advisor, but that's an idea there. So interesting sector there. It's a defensive sector. It's not. It's one of these sectors people go into when they're afraid there's going to be a recession or something because the earnings are stable. So interesting things. We looked at sectors, looked at all kinds of information. Again, more in my blog post. Read that. Look, if you want more videos like this from me, hit the like button. If this is the first time you've ever seen me on YouTube, hit subscribe below the video. Hit the bell next to that, and then YouTube will send you an alert as soon as the next video is up. And let's see what happens this week in the financial markets.